Today is 28th of January, and we are recording the video with tax expert Pieris Markou, the CEO of Deloitte. And we asked Pieris to give us some details on the new tax reform that was introduced in Cyprus. This meeting is a follow-up of our December meeting when we had an overview of the reform, but we were not sure what will be accepted or not. Now everything is done, yes? The reform is ready as it is now, as we described. It's not going to have any more significant changes. What do you think, Pieris?
Well, everything is done, but yesterday at parliamentary committee, they were talking about making some more changes. But as you said, not major changes, maybe some after experiencing the first month of the new legislation, they are considering making some changes, which will help in clarifying some of the items which came up during the application in the first month. So shall I share my screen and
yes,
then
share the screen, and in 15-20 minutes time make a break so I can read to you some questions if there will be any questions for this part of the presentation, and then we continue. Okay?
Okay.
All right, so we start.
Okay, so let me just okay, so as I said also in December when we met, I will cover the main aspects of the reform. Obviously, there have been a lot of changes, and it's not even 1 hour is not enough to go through the details. But the aim really is to try and cover the main aspects of the changes and the main issues that I think will concern us. So just to go on to the next slide, sorry. Okay, so just to recall, it's 6 legislations that have been amended: the income tax law, the special contribution for defense law, the capital gains law, stamp duty, assessment and collection of taxes, and the collection of taxes. So no surprises in terms of what was discussed up to December when we last met and what actually went through. In fact, what I thought I would do is, this is the slide I had the last time we met, and this, I'm not going to go through them again, but those are some of the positives and some of the negatives around the proposed changes. What we have seen, and I will cover some details later, is some of the negative items have not gone through. For example, taxation of provident funds, restrictions on some of the capital allowances for intellectual property companies, and also the restriction of interest on acquisition of 100% shares in subsidiaries. So that's a good point that through the consultations, they managed to maybe some negative things did not go through. Now, what did go through, and these are the main changes, I will go through these quickly. In the income tax law, we've seen the change of the carry forward of losses from 5 years, it went up to 7 years. So now a company can carry forward losses for 7 years. We have the introduction of a taxation of share options with a flat rate of 8%, but this is subject to conditions. Normally, if you receive share options through your employment, you would normally be taxed at the normal tax rates, which start at 20 and go up to 35%. This is a special scheme that if you meet certain conditions, you will pay only 8% on those share options. The tax treatment of ex gratia payments now is taxable only on amounts above 200,000 with a flat rate of 20%. But I have to make a note here that we are talking about ex gratia voluntary payments. If they're contractual, so if someone has in their contract that upon departure they will be paid an ex gratia amount, this is contractual and is not subject to this special rate. It will be subject to the normal rates. This is where it is not provided for, and it's an ex gratia payment, a voluntary payment by the employer. There's some additional research and development deductions of 20% over and above the 100% allowance that you would get. The income tax bands, and I have a separate slide on this to go through the details. The tax-free amount has increased from 19,500 to 22,000, and we have a widening of the bands. I have an extra slide for this. There's been introduction of personal deductions subject to income criteria, so you can deduct. And again, I have another slide to go through the details on the deductions. Entertaining expenses for companies is allowed as a deduction up to 30,000. It used to be the maximum was 17,000, so they increased the limit. There was an abolition of a minimum tax on insurance companies. Insurance companies on life would pay a minimum of 1.5% of their premiums collected. Now that's been abolished. Cryptocurrency transactions are now subject to a flat rate of 8%. Again, not included in the normal taxation, but they are taxed at a special rate. There's deduction for permanent or partial disability premiums. Your life insurance used to be deductible, is still deductible from your personal tax computation. They are now added any extra premiums you pay for partial disability or permanent disability. Before it used to be only for life cover, so now it includes this additional benefit. Also, you're allowed to deduct any payments you make to an insurance company to cover your home for natural disasters, up to 500 euros a year. And they clarified the other day at Parliament that it doesn't have to be your main home, it can even be your holiday home. So the law allows you, whenever you take out an insurance policy, to cover your home for natural disasters, up to 500 euros will be deductible. There is also a deduction for employers who apply the COLA, the ATA provisions, over double of the cost of the ATA, the COLA cost of giving increase to the employees. Again, this is subject to the agreement made by the ministry and the employer federation and the chamber of commerce and the trade unions. There is still some clarifications here because it's not clear whether you get the whole amount of the increase that you give or the amount above the 66%, which was already an obligation to give. But we're seeking clarifications. But in any case, there is an extra allowance to encourage employers to give the COLA, which is the inflationary increase on salaries, to their employees, even if it's outside of a collective agreement, so even a private agreement. So if I have an employee who has an employment contract, which provides that he will be paid the inflationary increase every year, I will be able to deduct not only the cost of the salary increase, another 100% again on top of that. Finally, there is a deduction for a company that wants to list its shares on the regulated stock exchange. The cost of up to 300,000 euros paid for the listing will be tax deductible. Some of the negatives around the income tax law, we've seen an increase in the corporate tax rate from 12.5% to 15%. There was a rule around the 60 days residency, which allowed people that were resident in another country, were tax resident in another country, not to be considered resident in Cyprus if they were spent more than 60 days in Cyprus. This has been removed. So now you can be tax resident in another country, but also tax resident in Cyprus if you spend more than 60 days, which is a bit of a problematic issue, but they decided to remove it. Obviously, there are other conditions. For example, if you spend 183 days in another country, then you are not considered resident in Cyprus. What they removed is there was a general provision that said if you are tax resident somewhere else, then the 60-day rule doesn't capture you. What happened there, some people were taking advantage of some jurisdictions that would issue residency certificates without really checking. And they would show to the tax office, look, I'm a resident of, I'm not going to say location, of Seychelles or for PVI or whatever. So you cannot tax me for being a resident in Cyprus more than 60 days. Okay, the condition for a company not to be tax resident in another state, again, something similar for companies. So if a company was resident somewhere else, then it would automatically not be resident in Cyprus. That has been removed as well, again, because some companies were taking advantage of a loophole where they can be registered, they can be resident in another country but not pay tax in that other country. So that has been removed as well. Um, a very disadvantaged change is the redemption of units in funds. This used to be tax-free. It used to be considered a disposal of shares. Now it is considered a dividend and would be subject to the provisions of taxation of dividends. But this will be this will come into effect from 2031. They wanted to give time to the people who hold units in collective schemes, in collective funds, if they want to dispose of them, to do it before 2031. There is some changes on the losses. If you have a group, you can use group relief, use the losses of another company against your losses. They've put a provision that you have to use firstly your own losses and then group relief. This creates a bit of a problem because your own losses, as I mentioned earlier, you can carry them over for 7 years, whereas the group losses, you can only use them in the same year. So it's a little bit of a disadvantage to ask you to use your losses first, which you may be able to carry them forward, and lose group losses that you may be able to use in only the specific year. Payments to provident funds and medical funds, there are some restrictions now. You can only deduct up to 10% of your salary to a provident fund and up to 2% to a medical fund. They didn't have these restrictions in the past. If some of you recall, when you spend more than 90 days abroad working for an employer abroad or a permanent establishment of a Cypriot employer abroad, you get an exemption. Now they've put a specific provision that they would only give the exemption if the employer has a place of business in that location that you are spending more than 90 days. And again, here there were cases where people would travel to Mykonos and they say they went for business and were claiming the exemption. So they want to make sure that the employer has some kind of business there before they give you the exemption. And there's an extension on the connected persons to include directors as well. So I don't know, Natalia, if you want to. This is the income tax law. Just to go on some of the details of the new bans, and then maybe we can stop if you want to have some questions. The new income tax bans are what you can see here. So the tax-free amount is 22,000, and the top rate of 35 applies to taxable income above 72,000. So it's quite a good, generous change that they have done. And I have to say that this was pushed by the parliamentary parties and not the government's suggestion was something lower. So they pushed to increase these bans. The allowances that are subject to the family income criteria, you can deduct these following allowances, and I will show the income criteria on the next slide. So for your first child, you can deduct 1,000 euros. Your second child, 1,250. Third child, 1,500. This will be deducted from your taxable income. And in the case of a single parent, then that parent gets double the allowances because these allowances are available, one to the father or one to the mother. So if you are a single parent, you get both of them. So you get double the allowance. You can also deduct for any interest on housing loans for main residence or rent of up to 2,000 euros a year. And if you're spending on energy efficient improvement of your house or buying an electric vehicle, you can deduct up to 1,000 euros per year, and that is spread over 5 years if the expense is higher than the 1,000. Now, these allowances are only given to those who have this income. So this is the gross income before any deductions. So if you are a family of up to 2 children, your total income as a family should not exceed 100,000. If you exceed 100,000, you're not allowed any of those deductions that I mentioned in the previous slide. If you have 3 to 4 children, your family income cannot exceed 150,000. 5 plus children, 200,000. If you are a single parent, the same limits apply. So, and if you are a single person, so without not claiming the child allowances, but claiming the other allowances, for example, the interest or the rent expense or the electric vehicle, then your income has to be up to 40,000. The discussions yesterday at Parliament, they suggested or the day before, they suggested the 40 to make it 50,000 to allow these deductions. Okay, so I don't know, Natalie, you want me to stop here for any questions, or shall we continue on the next?
I can see among the questions those that are related to income tax, and I suggest we look at them and we continue, and other questions will be asked later. So, how is gratia payments below 200,000 are taxed now? Is it through the incremental buckets?
Well, yes and no. If before the change, there was a provision that that said if it's upon retirement, then it's tax free. So before there were some general provisions, not very clear provisions, that allowed these amounts to be tax free for the whole amount, irrespective of any limits. Especially when they were voluntary. If they were contractual, they would have been taxable at the normal rates, in the normal bands. So the difference now is that the first 200 is tax-free compared to what it was before, which it had to be upon retirement to be tax-free. But if you don't meet, if it's not voluntary and it's contractual, the whole amount is taxable under the normal rates. So there is a benefit on the one hand that the 200 you can get it whenever you leave, doesn't have to be upon retirement. Whereas before there were some conditions that it had to be close to retirement.
All right. Another question is taxation of cryptocurrencies at 8% means taxation of the gain made on trading cryptocurrencies at 8%. Cost
Correct.
to calculate the trading gain is historic cost.
Sorry, what was
the cost to calculate the trading gain is historic cost?
Yes, because any fluctuations in the value is unrealized. So when you realize the gain, you look at the historic. The law doesn't clarify this. It just talks about the gains on the disposal. But in normal practice, you would look at the historic cost.
All right, one question more and then we continue, and other questions will be later. Do we count the taxation option scheme, provided that it's properly approved by the tax authorities, as a part of a total income? Can we include this income on the fifths or on the 1/5 that could be exempted, for example, insurance premiums plus health insurance plus social insurance?
So we are talking about a share option scheme which has a certain value, which will be approved by so it falls under the conditions of approval, taxable at the special rate of 8%. To be honest, I think it's included. It's not clear, but the law, when it talks about the income criteria, it talks about the total. Sorry, your question is whether it's in the 1/5. Yeah, that's a good. I think it will not be. If I recall, when we had the special taxation of other types of income in the past, they will be deducted from the normal calculation and taxed under a special rate. Similar to what you do with dividends, because dividends are included in the gross, but then you deduct them and you tax them under special defense. So I think the same will apply here. You would include it in the gross income. You would deduct it because it's subject to a special rate. So you will not get the 1/5 deduction. you're not included in the calculation of 1/5 because what they give you the 1/5 deduction against the normal rates, not against the special rates. And they do this also with the pension from abroad, which is taxable at 5%. It is not included in the normal calculation so as to get the 1/5.
Mm-hmm.
So my answer, I expect that it will not be included.
All right. Okay, so we continue with the presentation, and I suggest then we will finish it, and I urge our participants to write more and more questions, and when we finish, we will answer the rest of the questions.
Okay, so looking at the special defense law, again, this was the slide we used last month. And again, in this case, we have seen some improvements. There was an attempt to tax when you had an intermediary company for dividend tax. They removed this. And what are the changes now that we have seen? In more detail, there is a reduction in the special defense on dividends from 17% to 5% on profits of 2026 onwards. So if you make any distributions of old profits of up to 2025, they will be subject to 17%. So the 5% applies only to profits made on 2026 onwards. The deemed distribution provisions have been abolished from the 1st of January 26. So we don't have this assumed dividend of 70%. The special defense rate, special defense contribution on rental income has been abolished. So those both for physical persons and companies. There was a 3% tax on 75% of the rental income, gross rental income, irrespective of your expenses. That has been abolished. So that's a good development. The exemption from STC for Cyprus non-domicile resident individuals, if you recall, they are allowed for the first 17 years not to be subject to special defense contribution. They can extend this for 2 additional 5-year periods by paying a lump sum of 250,000 for each 5-year period. Once they pay this amount, it is not refundable. So the next 5 years they will get the exemption. If they decide to leave the country, they will lose that money. They will not get a refund, and they can do this 2 times. So they can take it for another 10 years extension. And interest income for companies is exempt from special defense contribution, and it's subject to income tax only, which again is a good development. And the opposite also applies to individuals. I haven't mentioned it here, but individuals are subject to STC on their rental income and not income tax. And the reason why I say this is a good development for the individuals, for those that were non-domicile, because we had cases where people were maybe in Cyprus just earning passive income, and the tax office tried to consider that the interest was earned as a business and to tax it under income tax and not to give the exemption under STC. So now they clarified that for individuals, you pay only STC and you don't pay income tax. Because some people earning more than the 70,000 could be subject to 35% income tax rate. Whereas if they were non-domicile, they would not pay any tax at all on STC. Some negative developments is that the transitional rules between the 17 and the 5% are very complex. They introduce also a provision that says if a Cyprus company pays profits of the 2025 profits or up to 2025 profits in 2026 onwards to another Cyprus company, before it was tax-free, now they will pay tax at 17%. So here, those who have 2-tier companies, one Cyprus company belonging to another Cyprus company, there is a recommendation that they declare a dividend up to 31st of December 2025, so that will be exempt, and then it will take another, so then they pay further. They can do that by after 2031 to pay only 5% tax. If they paid in 2026, they will pay 17%. So there's some planning that one can do to avoid the 17%. If there is from a company to a company dividend. The redemption of units in funds I mentioned in the previous slide is now subject to defense after January 2031 at 5%. Before it was tax-free. This is a very big development. The bonus issues of shares will now be treated as dividends. So if a company issues a bonus shares to existing shareholders, before it was a capital transaction, it wasn't subject to any tax. Now it's considered a dividend and you pay tax as a dividend. Deemed dividend, there is a deemed dividend of 10%. If someone uses for personal use company assets, so they will take the value of those company assets, the use of those company assets, and they will consider that you received a dividend and you pay 10% on that dividend. Penalties and fines have increased quite a lot. And finally, for non-profit organizations earning interest, they are subject to a 17% tax on the interest earned, which is not a good development for non-profit organizations. So this is on the special defense. I don't know if we have any questions here or to continue.
I suggest we continue.
Okay. On the capital gains, again, these are the previous slides we used before. They managed to get rid one item here, which was really they were allowed to refuse to give you a clearance to transfer the property if either the seller or the buyer was not tax compliant. That was quite complicated because you could have a buyer who buys a small flat and the developer for some reason has a pending tax examination. They would never give you a clearance to transfer your property, so that wasn't felt it was fair. So that has been abolished. They have not introduced this provision. And also the exemption on selling of shares in the unregulated market. There's a slight change there. That's why I have it light green. We will see the details on the next slide. Now, what are the things that have gone through? The tax-free amounts on capital gains have increased on the immovable property, on any type of immovable property, not being your main residence or agriculture. It used to be 17,000 and they now made it 30,000 exemption on the gain. For agricultural land, it used to be 25, they made it 50. And for main residence, it used to be 85,000 tax-free, now they make it 150. There's been, this is where I mentioned on the unregulated market, before they were tax-free. Now, if you sell shares from an unregulated market, which of a company that has immovable property, only the first 50,000 will be exempt from tax. The rest will be taxable. Before it was not taxable at all. And one good development, the last item, is that now the exchanging land for or plots for with a developer in exchange of a flat, for example, or any other house being built by a contractor or a developer would be exempt from capital gains. The exchange will be exempt. It wasn't covered in the past. This is the anti-parohi for my Cypriot friends. This wasn't covered in the past. So now anti-parohi can be exempt from capital gain. You basically defer your capital gain until you dispose the next property that you exchange with. In terms of some of the negatives, before the change, the shares, if you were selling shares in a company that owned immovable property, you would only be subject to capital gains if the value of that property was more than 50% of the total value of the shares. They changed that to 20%. So now even a small value in a property, which is at least 20% of the total value of the shares being disposed, would be considered immovable property just for capital gains purposes, subject to capital gains. So that creates some problems. As I said, the exemption on the disposal of shares on the unregulated market has been abolished, and we mentioned the exemption of the 50,000 only. And again, penalties and fines have increased quite a lot, and there are specific deadlines when you make a disposal. Within 30 days, you have to pay the tax, and if you delay the payment of that tax, then there will be very heavy penalties. The date of disposal is supposed to be the date of the contract, so it's very important that you don't have much time to actually do this. You only have 30 days to do the calculations and make the relevant tax payments. In terms of the stamp duty law, the good things about this is what we had before, some changes. The good thing is that the whole legislation has been abolished. So no more stamp duties on loans, no more stamp duties on contracts, on leases, on transfer of property. The whole law has been abolished. They will continue to collect stamp duty on all contracts, on all transactions that took place up to 31st of December 2025. Any transactions after that date are not subject to any stamp duty at all, which is a very good development for businesses and for individuals who were forced to pay stamp duties on documents being signed. And lastly, the assessment and collection of taxes law. These were all negatives, unfortunately, the changes, and we didn't have any positive changes. These are the slides I shared last time. Just one minor change, the taxing rights, they wanted to increase from 6 years to 8. So the limitation of when they can tax someone to take it from 6 to 8 years, that has not gone through, although there is a slight change that did go through. And the payment of the tax under dispute did not go through. That would have been very difficult. For example, if the tax office did an assessment of 100,000 and you objected it, they wanted you to go and pay the 100,000 before they can examine the objection, which wasn't fair. So they decided not to pass that. So that's a relief. And also the provisional, today when you do a provisional tax return, anything above 70%, if you declare up to 70%, you're not subject to any penalties. They were planning to make it 80%, so you get a closer estimate. That has not gone through either. And in more details, what has gone through, I wanted to put a little bit more details here. Firstly, all tax resident individuals between the age of 25 and 71 will have an obligation to file a tax return, irrespective of whether or not they have income or not. So even a zero return, they have to submit their zero return. The one good development for people, for companies, is that the deadline for submitting the tax return has moved now to 31st of January of the year that follows the subsequent year. So you get 13 months. So that they have brought forward the deadline. It used to be 31st of March. But at the same time, they also moved the payment deadline for paying the balance of your tax to coincide with the same date. Before, it used to be you had to pay your tax in August and submit your return the following March, which made it difficult because everyone was pushing to get their financial statements finalized before August, even though the deadline was the following March. So now there's no pressure to pay your tax in August. You can pay your tax up to 31st of January following the following year, when it coincides with the deadline of submitting the tax return. This would help also a lot of the accountants who are being pushed to finalize the audits before 31st of August, so you can pay the balance of the tax due. So now these dates coincide, which is a good development. There are new provisions around the submission of the employer return, and we don't need to go into the details. Partnerships now have an obligation to submit a tax return. Before, partnerships did not have an obligation to submit a tax return. They are not subject to tax. So let's clarify, there's no change in the A partnership is looked through, is transparent, and you pay, and the tax is paid by the partners. But they now made an obligation to submit a tax return, and we haven't seen a copy of the return yet. We don't know what they would require, what the details that they would require, but there's a new obligation for partnerships. To submit an objection against an assessment, it used to be the end of the month that follows the receipt of the assessment, which gave you a little bit less than 60 days, because if you receive the assessment on the 15th of the month, you have to submit an objection by the end of the following month. So you had 45 days. Now they made it 60 days, irrespective of the end of the month or not, which makes it a little bit more complicated to calculate the 60 days, because is it 60 days from the date of the issue of the assessment, 60 days from the day you receive the assessment? So it's going to be difficult to calculate it, but that's what the law says. And as far as the ability for the tax office to issue an assessment, as of today, it used to be 6 years. It remains 6 years, but they count the 6 years not from the day that the end of the tax year, from you count from the date the tax return was submitted. So you get an extension of another year. So really they can, or if you are delayed in submitting your tax return, they're allowed 6 years from the date that the return was submitted. So that gives them plenty of more time as what it used to be in the past. And the taxpayer has an obligation to retain these books and records for this period that the commissioner is allowed to issue an assessment. And on my last slide, there was an obligation of individuals to prepare audited accounts if they're running a business, if they are self-employed and they had income of more than 70,000. That has gone up to 120,000. So now those have an income of more than 120,000 have an obligation to prepare audited accounts. The commissioner has the right to suspend the operation of a business where the taxpayer has not submitted his tax return for a predetermined period or failed to pay taxes due of 20,000 or more, or has not issued any invoices, so really has not been compliant with his or her obligations. The tax office does have the right to enter the premises and suspend business, lock up the office. Understand their provisions there that they have to give you notice 3 times, to warn you that they're coming, to give you time to correct. And if you haven't corrected, then they will come and close down the shop. Interest refunds are paid are paid from 4 months after the return has been submitted, or if or the date the commissioner has determined the refund. So if they have their examination and they determine the amount to be refunded, you will get the interest from that date onward. So that is not really fair to the taxpayer, who probably paid the tax well before, and so it's not from the day the tax was paid, but from the day the commissioner has finally determined the amount. The TD7 is the employer return. The deadline is 31st of March. Rental payments can only be made through bank transfers or credit cards or any other electronic means, but not in cash. And they were discussing the other day at Parliament to put penalties for the person making the payment of the rent if they do not make it through a bank transfer. Penalties again have increased in line with other laws as well. This is a very important development for directors. A director of a company will continue to be liable for actions or omissions that took place during his or her term, despite the fact that at the time of being examined, he may have resigned as a director. So if I was a director in 2026, and for some reason there are taxes that have not been paid, and by the time the tax office examines is let's say 2030, and by that time I resigned as a director, I will still have an obligation. I will continue to have the liability as a director and all that could mean by being a director, even though the tax commissioner may have issued the assessment in 2030. So that's a very important development for those acting as directors. And finally, the commissioner has the right to register a memo over the shares of the company, to basically put a memo on the shares. If a company refuses to pay up to 100,000, from 100,000 and more of taxes, which again can create complications. Those shares may be pledged to the bank, they may be pledged for another company, but the commissioner would claim a memo on those shares will not allow you to make any transfers of the shares until you pay your taxes. So that's covered it in 40 minutes.
It means
So
we have a lot of time for questions, and we can have
yes,
also discussions, not only questions. I
so
will
I stop sharing.
allow our colleagues to unmute themselves, to start video if they want. And let me read the questions that we have in the chat so you can also follow my reading, because sometimes it's very long text, not to lose anything. So Jat asked, I have a question regarding capital gains tax on plot exchange. And you already replied, he asked a bit earlier than you replied, that antiparochi now is not taxed at the moment when they exchange, and only when they have profit afterwards. Okay, I will continue. Is there a point in time when tax becomes due other than through the sale? Okay, there is a second part of this question. Is there a point in time when this tax becomes due other than through the sale of the flats received
No, the
from the
answer
return
is
of the plot?
no. It's paid when obviously we are talking about the equal value. So because if you receive if you receive something of less value than what you have sold or what you have exchanged, you pay on the difference. But assuming they are of same value, then you will pay on tax only when you dispose of the flat. But your original cost would be that cost of that plot that you have purchased originally. So you're just deferring the capital gain to be paid when you dispose the flat. If you then exchange that flat for another flat, then you continue to get the deferral.
All right, dear friends, you may switch on your video. So Farah also switched on. So we look at her, we smile at her. If you have some more videos, it will be nicer. So we will see you, talking to you. And I will read the next one. Andrei is asking, it's ex gratia. How you pronounce it? Ex gratia?
Ex gratia.
Ex gratia. Okay, now I know. Ex gratia means one-off payment in a lifetime, or it can be a golden parachute or bonus for performance.
It covers a lot of items, to be honest. I didn't put everything there, but it does cover a golden parachute. I think that means a golden handshake, for example, to give someone an incentive to join you. It also, I think, covers the bonus. It doesn't. A bonus is related to performance, so that is fully taxable. Again, I have to repeat that it has to be a voluntary payment. There is a list of what items are taxable or not taxable, but the general idea is that if it's not provided in the contract, it's of a voluntary nature. Then, for example, let's take those bank employees that were given a special scheme to leave because of the merger of the banks. Those up to 200 will be taxed because they are voluntary. They do not have it in their contract. They offered to them an incentive to leave, so that would be something that would benefit from the 200,000. So the general idea, if it's not contractual, then you are allowed the 200,000. If it's contractual, then you don't fall under the criteria and you will be taxed under normal rates.
Pieris, the company that is paying the ex gratia payment to an employee, can we use this expense and deduct it? No, right? Because this is important. Because if the company deducts it, then it's not an ex gratia payment.
It's not allowed, and a specific provision that doesn't allow it.
Yeah. So this has to be made clear. The employee needs to obtain something that the company will not charge it.
Correct. So it's a cost to the company.
Yeah.
Yes, colleagues, if anyone else wants to comment on this subject, you may switch on the microphone and comment, otherwise I will read further. The next one, SDC on dividends. Can a company keep old profits for reinvestment, for example, and distribute post-2026 profits as dividends instead?
As I said, there are complex provisions, but the laws up to 2025, the 70% will apply. So, but the 30% which remains behind, you can keep those. If you pay them up to 2030, you pay tax at 17%. If you don't pay them and you keep them, you pay them after 2030, so in 2031, then they're subject to the 5% tax. So there is a period of 5 years which they allow you can keep them, but this is only the 30%. So if you make profits in 2025, the 70% still applies because it's the previous legislation. You will have to pay 17% of the 70%, but the 30, you can keep it in the company. You don't need to pay it. There's no provisions to force you to pay it. If you pay it until 2030, you pay 17%. If you pay it after 30, you pay 5%.
But for the 2026 profits, everything is clear, 5%.
5%, yes.
Mm-hmm. All right. Regarding
and
profits,
there is no, and also in 2026 onwards, there is the 70% has been abolished, so you can pay as much as dividend as you want. You're not forced to pay the 70%.
Mm-hmm. Also the questions about profit. Regarding profit generated up to 31st of December, which will be distributed as dividends after 31st of December 2031, and could you please clarify whether these dividends will be taxed 17 or 5? It's exactly, so Odysseus who asked this question, he exactly meant what you just answered. So
yes,
after...
it will be 5.
Yes.
It will be 5%, but only on the 30%, because the 70 you already apply the deemed dividend of the 70%.
Okay, so on the remaining 30.
Yes, on the remaining 30%.
All right. Interim dividends during 2026 will be taxed at 5%. Question will be interim dividends.
Yes, if they are of the 2026 profits, yes.
Okay. So the sale of business limited company is now taxed at 20%.
No. Sorry, I wasn't correct. No, the sale of a business. You mean the goodwill or shares? You mean
Andrei,
shares?
could you clarify, please?
Shares.
Yeah, well, I mean, if you just basically build up a company and you decided to sell it, whatever business, whatever is the business, I mean, and whatever way you're selling it off, either by shares or by anything else.
Yes, no, the sale of shares is only subject to tax if the value of the shares includes immovable property based in Cyprus, which has a value of more than 20%. The law currently provided that if it had value of, if the company had immovable property that had up to 50% of its value in immovable property, they changed it to 20%. If you're selling shares of a company that doesn't own immovable property in Cyprus, there is no tax.
Mm-hmm. So it stays like it was. Yes?
Yes,
no
the sale of shares remains the same. The only change is the underlying immovable property situated in Cyprus. Now, if it's more than 20% of the total value of the company, then you pay capital gains on that part of the immovable property value. You don't pay on the whole of the value of the company.
Yeah, but you were talking something about the unregulated markets. And the sale of shares on the unregulated
Again,
market.
this is only for capital gains. So even if it's so before you would have shares in an unregulated market which owned immovable property, which were exempt. So again, in order to pay tax, it has to have immovable property. If you are now listed on the unregulated market, and you have immovable property, then you pay tax. Is that clear, Andre? So the comment on the unregulated.
Yeah. I'm guessing. No, I mean, whenever there is property, then there is capital gains. Okay.
Yes.
All right, thank you. And the last
The
question
property
that
is
we have.
outside of Cyprus.
If the
Cypriot
property is outside of
company
Cyprus,
holding a property outside of Cyprus.
there's no capital gains if it's outside of Cyprus.
All right. The last question that I see here, there is a 1 month deadline from the date of signing the immovable property sales agreement to pay the relevant tax. In cases where the completion is delayed due to the tax department delay in issuing the tax clearance, will penalties still apply?
Well, it's not the way it works. You make a self-declaration, so you make your tax return for capital gains. You go and submit it. You pay your tax. Now, if they are delaying the valuation, for example, you still have to pay based on your own valuation to avoid the deadline and the penalty. And then after, if they make a revision of the value, you pay they issue a new assessment. So they issue, and you pay that assessment. So there's no penalty on paying the revised assessment. But as a self-declaration, you have to do it within 30 days.
A question: if a company sells the immovable property, normally you have to get the tax clearance. How you deal with this?
A company would still have to pay capital gains. So it's the same thing. If it pays income tax, if the company is selling the property is, for example, a developer and pays income tax, then again they go and pay income tax. They don't pay capital gains, but they do a calculation on 15% corporate tax, and they pay the income tax. They do it through a provisional return. But if it's capital gains, it's the same process. The fact that it's a company doesn't make a difference. I don't know what you have in mind, though, this says.
Based on my knowledge, you have to receive a tax clearance if you're a company and selling.
Yes, but you still have to make your declaration as a company of your immovable property, and then yes, you need a clearance. Anyone needs a clearance. Even the physical persons need a clearance to make the transfers. So it's the same process for companies and individuals. So the only difference is if you are a developer, you don't pay capital gains, you pay income tax. Again, there you make a self-assessment. You pay an income tax, and then they give you
that means you are paying the tax before receiving the money from the sale.
Well, you may be right. There are provisions in the capital gains law that allows you to defer the payment of the capital gains based on the way the contract provides for the payment of the proceeds. So you can apply for this, but usually. I would assume there would be a first payment upon the signing of the contract, and then you would exchange only after you maybe receive the balance after you exchange. But yeah, you're right. I think there may be some time difference in the collections, but that's why you should make sure when you sign the contract to include at least a deposit to cover the tax.
Right, so now any comments are accepted, not only questions. Any comments, any additions? So I see on my screen Marilia, Sarah, Kostas, Odysseus just spoke, Nikos, Farah, Sudeep, and we have 21 people there. So anyone, the floor is open. Yes, Nikos.
Yes, on the treatment of the disposal of shares of companies listed on the unregulated market. So effectively, those companies are treated like any company which is unlisted. And therefore, if they own immovable property, provided the immovable property exceeds 20% of the total value of the company, then the shares are subject to capital gains tax. If not, they are exempt.
Correct. Well, they gave an exemption. The 50,000 gain is exempt. I think they did it. Originally they want to tax the whole amount, but they finally gave a 50,000 exemption. but it's not a big amount, as you can appreciate.
Okay, but the 50,000 exemption applies provided the immovable property exceeds the 20% of the total of the company. Yeah. Okay.
I'll make one comment on the personal tax and all those allowances that I mentioned. You can appreciate that it creates a lot of complications. Firstly, you have to give the consent. If you are a couple, you have to give your husband's consent or you need to know your husband's income, for example, or your wife's income, so that you know whether or not you're in the band. You also need to get them to give that consent. So that's one complication. Some people, they don't want to share with their spouses their income. So that's one complication. The other complications that arise is, for example, if you are a divorced parent and the other parent pays support to the child, does that other parent, is he allowed, but the children are living with the mother and the parent is paying for child support? Who is entitled to the allowances? Because the law talks about those living with the parents are allowed. If you are a divorced, you're allowed that person living with the parents. But if the other person is paying for the children, so there are some complications, and these were discussed at Parliament on Monday or Tuesday, I think on Monday. So they are trying to look into this and make some clarifications. Even they mentioned that they would change the law. This is what I said at the beginning. There will still be some changes because, for example, in the income criteria, they want to include the allowance paid by the father to the divorced mother, or the other way around. I don't know how it works, as to count towards the income criteria, which is ridiculous if you ask me, because it's not income that is subject to tax, so why include it in the income criteria? So there are a number of, in my mind, they made it much more complicated than what they should have in order to introduce all these allowances, making it more difficult for people to claim them. Even for a single person, they put a limit of 40,000. I mean, most people will not get, these allowances because you include all types of income and all the gross income that you have, even though it may be exempt from tax or not. So it's not easy to get those allowances.
All right. The question is whether we will share the presentation afterwards to our club members.
Sure, I can send you, as I did last time, as a PDF. I wouldn't use it as a Bible because it's very simple. If you want the Bible, you have to take the law itself, which, believe me, for us, even though we are experts, we find it very, very difficult to follow. There's been
how many pages approximately it has? Is it thick paper?
The changes, there were something like 200 pages.
200 pages.
It's just and now they have to consolidate those changes and put them in the main law, so that we read the law as it is, as a new law, which I haven't seen it done yet. So it's difficult, and as I said, there will be more and more things coming up in the practical application of some of these things that are now being applied. So it'll be good to go through. And I'm sure there will be more and more meetings to clarify a lot of things around the new changes.
Thank you, Pieris.
I tried to be brief because it's very complicated and a lot of details in the new legislation. Sorry, Nikos.
It was very informative. Yes, Nikos.
Yes, one more question. The 60 days limit for filing an objection against an assessment. It's a little bit unclear from which date does it apply. Are they going to clarify this point, or is it going to...
You're right, Nikos. It's unclear. I'm as if I have in front of me I don't have in front of me the laws, but the previous provisions provided that it was the end of the month following the month that you received the assessment.
Yeah.
And now they say 60 days, but I can't remember if it says from the day they received the assessment or from the day the assessment was issued. It's only fair to be from the day you receive it, because we know the Cyprus post system and how long it takes to deliver a post. So if it's from the day you receive it, if it's registered, you can go online with the registration and you can find the specific date that they delivered. But if it's not registered, then it's not easy to prove the date. And you can appreciate the administrative cost of the tax office, because now it's not the end of every month, it's 60 days. So you'll have deadlines during the month, which in my mind is administratively, it makes it difficult.
But the deadline is for the taxpayer rather than the tax department.
Yeah, but also the tax office to decide whether they will put the penalty or
accept
not.
it or not. Yeah.
So yes, so it's difficult. It's not easy.
We have a question regarding crypto. Sarah has discussed the tax reform with many Scandinavian tax advisors last week, and they are all questioning why we have a special tax treatment for crypto. They ask me why it's not taxed as a currency or as an asset. I do not have a good answer, do you?
I don't have a good answer either, but I think maybe it's considered an incentive to encourage entities that are dealing in these transactions to set up business in Cyprus. There was a provision there is still a provision on Forex, but it's a little bit different there, because it says any foreign exchange gains or losses are not taxable unless they're of a trading nature. So there's also some benefit on the Forex, but this is only for a normal trading company which has a Forex difference. They said this is not taxable, but this was already in the previous law. But on cryptos, to be honest, it was being pushed that we wanted a special regime like we have for shipping, like we have for other types of entities, to encourage companies to set up here. So it's more of an incentive to bring more business to the Cyprus economy. This is why.
I don't see it as an incentive, though. I mean, they're taxed more than if it would be.
It's 8%.
Yeah, but if you can have it in an ID, for example, for a lower. Yeah.
Yes. Okay. If you do planning, and you reduce it, but I'm just wondering the profit. I think it's a good point. I need to look into it. Maybe how you determine the profit, will you be allowed to deduct the NID, and on the balance you pay 8% as opposed to 15%, because so you still get a lower effective tax. But it's a good point, and I will need to look into it with our experts, because I believe you're right. If they are entitled to NID, they would pay effectively 3% tax.
Yeah.
Now, maybe they'll do the NID, and then you pay 8% on the profit after the NID. But
if you have a good way around that, please contact me, and we will do some for my clients.
Yeah, we will check it. We will check it and come back to you.
Thank you.
We'll have a question from Dimitra. She's sending her best regards and thanking for the presentation. So she believes that the tax on capital gains on the ECM market and on the funds will be disadvantage to attract property funds or companies. What was the reason behind this decision?
I agree 100%. Dimitra is very right. To be honest, I'm not in the tax committees of the Institute of Accountants, but the Institute of Accountants and myself, through the Chamber of Commerce, we made representations that they should not do this. I think the reason why they did it is that some people or some companies were taking advantage, some local companies were taking advantage of the registration on the unregulated market. And were transferring their business to an unregulated market. There was not really a lot of transactions on those shares. They were just being placed there without any really incentive to attract funding through the market, or to even having transactions through the market through third-party shareholders. And they were just doing this to take advantage of the exemption. So they wanted to attack this, I would say. But definitely I agree with Dimitra. It's not a good development. And but they were insisting on doing this because of some companies taking advantage of the loophole, I would say. And I also know the stock exchange also made representations against this change. But and also the disposal of the, as you said, the funds again is a very disappointing development when you redeem shares in collective schemes to be taxed. Very unfortunate development. Again, I was involved at the time when it was the exemption was already originally introduced, which was the aim to attract the setup of funds in Cyprus. And at the time, the government introduced this exemption clearly to encourage the setup of funds in Cyprus. And now, by doing this, obviously, it doesn't help. It takes us back 20 years. But I agree 100% with Dimitri.
All right. So,
If you don't mind, about these provisions. Like, I know that this was supposed to be a tax overhaul and everything is new and so on, and they haven't done it in years. But the specific provisions, like the stuff that you've discussed now, which are not a very bright idea, what is the probability that once this gets implemented, future governments might, or the parliament might review and amend provisions in the tax law gradually to maybe correct some of the mistakes or refine some of the issues that this new tax law will create?
I think obviously we continuously make changes to encourage foreign investments and to encourage business environment. So I agree that this will be reviewed obviously throughout the practice to see how it develops. And certainly if there are areas that we believe they should not have been made, to correct them. But I would see this would be happening more around some of maybe the removal of incentives or some changes that need to be clarified to make it more attractive. I don't see, however, any changes being made to remove some of the powers given to the commissioner, which are really around collecting taxes, because generally the parliament wants to help the commissioner have powers to collect taxes. And to be honest, during the discussions, it was most of a bargaining. It was used as a bargaining tool that I will give incentives for personal tax. I will expand the bands. So he accepted to give these, shall we say, more incentives around personal tax, because that gets you votes. And this is what Parliament was trying to get. And at the same time, help me get through some of the most strict provisions around collection of taxes, to make people more transparent and more have more penalties and be more strict on making people pay taxes. So I think it was a two-way type of give some incentives, but help me get through some of these tools that I need to collect taxes. But I agree that some of the provisions that helped the businesses and now have been removed. There will always be an attempt to try and bring back or improve some of the areas around incentives.
All right. I suggest to summarize. First of all, I would like to thank you. You said that it was very difficult to put a lot in the short presentation, but it was very comprehensive. We really appreciate it. And
thank you. Although, as I said, there are a lot of details, and I know that some of the companies are making full-day presentations. So this is how detailed it is, and Deloitte will also be making some presentations. But generally, this was an attempt to summarize the main changes. And as I said, it's not the Bible, because if you want the details, you need to go to all
the laws. 200 pages that you mentioned.
Yes.